For years, investors have been asking the same question: what happens after Novartis loses exclusivity on some of its biggest blockbuster drugs? In the pharmaceutical industry, a patent cliff can erase billions of dollars in revenue almost overnight, and history shows that many companies struggle to recover. But this earnings season tells a very different story. Instead of collapsing under that pressure, Novartis continues to grow, powered by a new generation of medicines and one of the strongest pipelines in the industry. So, has the market underestimated Novartis' ability to reinvent itself, or has the stock already priced in too much optimism? In this video, we'll look beyond the quarterly numbers to understand what has really changed, assess the sustainability of its growth, and determine whether Novartis still deserves its premium valuation. For years, the biggest concern surrounding Novartis wasn't whether it could develop innovative medicines, it was whether those new medicines could grow fast enough to replace aging blockbusters losing patent protection. That concern was entirely justified because drugs like Entresto and other mature products contributed billions in annual revenue. However, the latest results suggest the transition is progressing better than many investors expected. Instead of relying on a single replacement product, Novartis is building a diversified portfolio of growth drivers, reducing its dependence on any one blockbuster and creating a more resilient business model for the years ahead. The company's growth is no longer driven by a single blockbuster. Instead, Novartis now benefits from multiple high-growth therapies across immunology, oncology, and neuroscience. Medicines such as Cosentyx, Kesimpta, and Scemblix continue to deliver strong momentum, helping offset the decline of older products facing generic competition. This diversification is strategically important because it reduces concentration risk while creating multiple sources of future revenue. For investors, that's a meaningful shift, from depending on one winning drug to owning a portfolio of innovative medicines capable of sustaining growth over the long term. Quarterly earnings may move the stock for a few days, but long-term value is determined by the next generation of medicines. That's why investors are paying close attention to Novartis' late-stage pipeline, where several promising therapies could become future blockbusters if approved. Success would extend the company's growth well beyond today's product portfolio, while failure could make the current premium valuation much harder to justify. In other words, the pipeline isn't simply supporting the business, it is shaping what Novartis could look like over the next decade. Novartis has always competed through scientific innovation, but its competitive advantage is becoming broader than just discovering new drugs. The company combines deep research capabilities, global commercialization, manufacturing expertise, and disciplined capital allocation to repeatedly bring high-value therapies to market. That integrated model makes it increasingly difficult for competitors to replicate its success. Rather than relying on one breakthrough medicine, Novartis is building an innovation platform designed to continuously replenish its portfolio, strengthening its competitive position as older products gradually lose exclusivity. One of the clearest signs of a high-quality pharmaceutical company is its ability to translate innovation into consistent financial performance. Novartis has continued to generate strong profitability, healthy cash flow, and disciplined capital allocation even while navigating patent expirations and investing heavily in future growth. That balance is difficult to achieve in an industry where research spending is both essential and uncertain. For long-term investors, these financial characteristics suggest that Novartis is not simply growing, it is doing so with a business model designed to create sustainable shareholder value. Despite its strong execution, Novartis is far from risk-free. The biggest challenge is maintaining a steady flow of successful product launches as more mature medicines face generic competition over time. At the same time, every late-stage clinical program carries meaningful regulatory and commercial uncertainty. Even an exceptional business can disappoint investors if future innovation falls short of expectations. For that reason, the key question is no longer whether Novartis is a high-quality company, but whether it can continue renewing its portfolio fast enough to sustain long-term growth. Markets don't always misprice a business because the fundamentals have changed. More often, prices move because investors' expectations and emotions change much faster than the business itself. Fear can push high-quality companies well below their intrinsic value, while optimism can drive prices far beyond what fundamentals alone can justify. Understanding this difference is critical, because successful investing isn't just about analyzing businesses, it's also about recognizing when market psychology creates opportunities. Following another strong earnings report and another increase in full-year guidance, market sentiment toward Novartis has clearly become more optimistic. Investors are increasingly confident that the company can continue growing well beyond its patent cliff, and that confidence is now being reflected in the share price. But successful investing isn't just about recognizing a great business. It's also about understanding whether today's price reflects rational expectations or growing market enthusiasm. That's why I evaluate Novartis using 3 valuation scenarios. Rather than predicting a single target price, this framework helps distinguish between periods of fear, normal market conditions, and excessive optimism, allowing investment decisions to remain grounded in business fundamentals rather than changing market emotions. Based on my 3-scenario valuation framework, Novartis' conservative value is approximately $120 per share, representing periods when market sentiment turns more cautious despite stable business fundamentals. My base case value is around $138 per share, reflecting what I believe is a reasonable estimate of intrinsic value under normal market conditions. Meanwhile, the optimistic value reaches approximately $206 per share, representing periods when investor confidence becomes exceptionally strong and valuation multiples expand beyond their historical norm. Rather than relying on a single price target, these 3 scenarios provide a disciplined framework for navigating changing market psychology while keeping the focus on the long-term value of the business. Novartis has demonstrated that a successful pharmaceutical company is built not only on today's blockbuster drugs, but on its ability to continuously replace future revenue through innovation. The company has successfully navigated one of the industry's biggest challenges, the patent cliff, while strengthening both its growth profile and financial quality. Although market sentiment has become increasingly optimistic following recent earnings, my investment approach remains unchanged. I focus first on business fundamentals, then on valuation, and finally on whether market psychology creates an attractive entry point. For long-term investors, Novartis continues to stand out as a high-quality business capable of compounding value over time, provided that future execution remains consistent with today's investment thesis. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.